Welcome back to Alpha Recap from StockAlpha.ai. I'm Martin, and with me is Evan. Today we've got earnings beats, a tale of two markets, and some gut punch microcap moves. Let's dig in.
Hey everyone, Evan here. I'm pumped. This was one of those days where the big names looked steady and small names looked chaotic. Apple delivered a nice surprise and then some tiny names just imploded. We'll walk through what that means for different investors.
Quick headline. Apple reported adjusted earnings per share growth of about 13%. That's the clearest signal that margins are holding up in the megacap world.
Right, and by adjusted, they mean they stripped out one time or non cash items, stuff like stock based pay or restructuring. Adjusted earnings per share is trying to show the company's operating earnings power without the noise.
That matters because when a company the size of Apple shows double-digit adjusted earnings per share growth, it's not just a one-off blip. It suggests operating leverage, revenue growth translating into outsized profit gains. Revenue growth.
But Martin, there's a debate. Some analysts say 13% could re-rate the stock higher. Others caution this might be a single quarter boost and that macro volatility or stretched valuations could limit that re-rating. So keep an ear on management commentary at the next conference call.
Exactly. Listen for the color on product mix, services growth, and cost posture. Those are the drivers that tell you whether that margin strength will persist.
On the banking side, QMB beat expectations for the fourth quarter of 2025. Both earnings per share and revenue came in ahead of forecasts. That's helpful for regional bank sentiment right now.
A bank beat usually points to either net interest margin strength, fee resilience, or good cost control. For income investors, that kind of result makes the dividend story more credible, but always check payout ratios and capital adequacy.
Speaking of dividends, Nike is on the cusp of becoming eligible for the S&P Dividend Aristocrats. That requires 25 consecutive years of raising the dividend. Inclusion often triggers passive inflows from funds that track aristocrats.
Small structural flows can matter. It's not a fundamental change to the business, but if lots of funds must buy it, that steady demand can tighten valuation spreads a bit. Still, it is incremental and not a magic fix for top-line weakness.
Mid-cap Dowlais Group also surprised in a good way. Full year 2025 performance came in ahead of management guidance. That's the classic trading update that can change expectations for cash flow and capital allocation.
Right. When management beats guidance, it raises the probability of reinvestment in the business or shareholder returns like buybacks or dividends. But some skeptics say trading updates can be tactical, not always a structural improvement.
Now for the other side of the tape, microcap carnage. We saw a string of one-day collapses, each down more than 30%. These moves are dramatic and scary for small holders.
Let me give some color. One stock slid about 34% to roughly $5 on about 585,000 shares. Another plunged about 35% to around 3 cents on roughly 19,000 shares. One fell about 35% to approximately $2.80 on about 12,000 shares. There was even a collapse to a penny on only 50 shares traded. And one name dropped about 37% to roughly $100 on about 120,000 shares.
Those are brutal numbers. The common thread? Tiny absolute prices, tiny volumes in some cases, and outsized percentage moves. When you see 50 shares traded and a 37% move, price discovery is basically broken until liquidity comes back.
Right. These are often liquidity or, quote, artifact events rather than fundamental re-ratings. That's why retail and institutional investors get burned. Tight or no market makers, stale quotes, or concentrated selling can blow up positions fast.
A separate but notable item. Advanced Digital Forensic Solutions rolled out a full rebrand tied to its 20th anniversary. That's strategic and perceptional. It won't move revenues today, but it could help with customer acquisition if it's backed by real go-to-market investment.
Branding is marketing leverage, not earnings. Treat it as qualitative improvement unless they pair it with measurable sales or product investment numbers.
Let's talk what this means for different investors. Long-term growth investors. The Apple and QMB beats are constructive. They reinforce the case for quality and margin resilience, but you should vet sustainability, revenue mix, recurring streams, and margin drivers.
Income investors should watch Nike's potential aristocrat entry in banks like QNB. Aristocrat inclusion brings slow, structural demand. Still validate payout ratios and capital position before committing.
Contrarians and value traders might like Dowlice's ahead of guidance update, but microcap collapses are trickier. They can be opportunities only if you confirm liquidity, corporate health, and no looming regulatory issues.
Short-term traders will see volatility in those tiny names, but execution risk is huge. Wide spreads, slippage, and borrow costs can wipe out theoretical gains.
For risk-averse and retail investors, today is a reminder. Size positions so you can exit without moving the market. Avoid concentration in illiquid stocks.
Operationally, here's our watch list. Reassess position sizing in illiquid names. Monitor Apple's conference commentary for persistence of margins. Track index committees and ETF flows for Nike. Verify bank fundamentals for dividend plays and watch for follow-on disclosures from those microcaps.
Also, treat rebrands like Advanced Digital Forensic Solutions as tactical until they show measurable customer or product investments. A new logo won't pay the bills.
Quick recap. 3 big takeaways. 1. The large cap and mid cap picture shows durability. Apple's 13% adjusted earnings per share growth and QNB's beat gives selective confidence. 2. Microcap moves underscore liquidity and idiosyncratic risk. Single session 30% plus losses on low volume are a red flag. 3. Index mechanics and dividend status, like Nike's aristocrat candidacy, can create structural demand separate from fundamentals.
If you remember one thing today, tilt toward quality and income where appropriate, but size positions and manage liquidity risk. And for traders, respect the microstructure. Small names can be brutal.
That's it for today's Alpha Recap. Thanks for listening. I'm Martin.
And I'm Evan. Catch us next time for more market color and smart takes from stockalpha.ai. Stay curious and trade carefully.